PSG Asset Management has been investing globally since 2008. And despite the problems that many identify with managing global portfolios from a local base, PSG Asset Management has won several awards over the years. Most recently, the PSG Global Flexible Feeder Fund and the PSG Global Equity Feeder Fund have both won awards at the Raging Bull Awards. So joining me today to discuss our global investment process is Deputy CIO and Fund Manager on our global portfolios, Greg Hopkins. So Greg, can you explain PSG's investment process to us from a global perspective?
Yes, thanks, Audrey. Yes, as you mentioned, we have been investing globally since 2008, which gives us over 15 years of direct global markets experience. We actually have one process, so our global and local processes are integrated, and we have one investment team that services that global process. And it's a deep team. We have 19 investment professionals. And we actually spend the majority of our time researching global companies. So we see ourselves as having pretty much a global process with South Africa included in that process. Those long-term investors in our funds will be familiar with our philosophy and process. We like to go into the areas of the market where the market isn't focusing, what we call the uncrowded areas. And there's a very simple reason. If there are few investors looking in a specific area, there's going to be less competition. And if there's less competition, it's more likely you're going to find bargains, some sort of mispriced quality. And then we apply our 3M process, modes management, margin of safety. And what we're trying to do is find some inherent quality that the market is missing. But more often than not, just given the type of markets and the type of areas we're looking at, we often find above average quality at below average prices. And that's very much the flavor of what we're seeing at the moment. And it's one of the reasons why we're very, very excited about the opportunity set that is being presented in the global markets.
So I think that for local investors looking abroad, the US market has been particularly attractive. And within that, the Magnificent Seven stocks, the big IT stocks, have been the really attractive ones for local investors. So can you tell us how PSG Asset Management is approaching this market?
Yeah, these companies, these large companies, the Magnificent Seven, have got a lot of attention. And it's interesting if you actually take a step back and you look at the structure of the US market and you compare it over time. The market is, the US markets particularly, are the most concentrated, i.e. the number of investors that are looking at a smaller group of shares. It's the most concentrated it's been since the Great Depression, which is a very, very long time. And that brings significant risks when you've got this euphoria, you're getting people sucked into this exuberance. It bids these companies up to very high levels, and the valuations of these companies are at very, very high levels at the moment. But on the other hand, the more concentrated the markets are, the greater the number of investors looking at a very small area, the more likely is that you're going to find bargains in the areas the market isn't looking at. And that's where we're finding the fantastic opportunities at the moment.
So Greg, can you give us some more ideas about what specific opportunities you are finding in these uncrowded areas?
Yes. So a good place to start is with the Bank of America Merrill Lynch Fund Manager Survey. It's a monthly survey. They survey over $500 billion worth of investor assets. Unsurprisingly, the markets are very excited about the US tech and US bonds, which we find actually quite surprising. And the areas the markets are ignoring or shunning are the UK, which is actually the largest underweight, Europe, emerging markets, commodities, energy, staples. And that's the area that we are super excited about. And it's interesting when you look at how the market is currently positioned. It's got a lot of similarities to back in how it was in '99, where you're getting market participants being sucked into a new theme. Back then it was the .com. Now it's AI. And they were back then also shunning the areas that they actually are currently also underweight. And if you fast forward the next 5 years from '99 through to 2005, these areas, emerging markets, commodities, areas outside the US actually did extremely well. And we think there's a high likelihood that history is actually going to repeat again. And there are very simple reasons for that. The firstly being starting valuations. A market like the UK now is trading at 30-year relative lows to the MSCI World, which is the average stock. The same for the Europe, for the Eurozone. And it's even more pronounced in emerging markets. The emerging markets at the moment are trading at 50-year relative lows to the US. Said another way, the market's as pessimistic towards emerging markets versus the US it's been in 50 years. And it's unsurprisingly, this is the areas of that we have been adding to our portfolios over the last 6 months.
So, Greg, I think looking at PSG Asset Management portfolios, it's often noticeable that our portfolios can appear quite different to those of peers or competitors out there. So can you talk us through the benefits that could offer for investors?
Yeah, the primary one will be in diversification. So we're focusing on a risk perspective. And as you mentioned, it does seem to us that a lot of local investors have got large weights in the US and these US tech companies. So having a portfolio like ours, which is investing in areas outside those popular areas, will bring diversification. It'll allow it'll allow investors to actually participate in more than one type of market theme. But the second part, when you're actually focusing on risk, we do think the markets are very complacent at the moment on inflation. And going back to the Bank of America Fund Manager Survey, the number of participants in that survey expecting inflation, a high inflation in the US over the foreseeable future, is the lowest we've seen in 20 years. And I said another way, the markets are extraordinarily complacent about inflation. And we would have a different view. We think there's actually a high probability that inflation will come back into the system. And it's interesting, the areas of the market that the market is actually underweight now or not looking at would actually be beneficiaries of high inflation in the future. And this is one of the areas that this is one of the beautiful things about what we call a free lunch, where you're getting very good companies with very good growth prospects on very cheap valuations, but with this added benefit that if inflation returns into the system, you get an additional tailwind. And that would be very complementary to investor portfolios.
Greg, it's been great talking to you. Thank you so much for taking the time and explaining the global investment process to us.
It's my pleasure.